All right, welcome to The Explainer. Today we're going to break down a really big investment idea, a thesis that argues the entire global economy is basically about to move house, digitally. So let's get right into it.
Okay, let's just start with the core claim here, because it's a big one. The argument is that we are standing at the very beginning of a technological shift that's as profound, as world-changing as the commercial internet was back in the 90s. Now that's a huge statement, so let's dig in and see what's actually behind it.
So, what exactly is this inevitable migration? Well, the theory is actually pretty straightforward. It's the idea that all the world's value, and I mean everything, from stocks and bonds to real estate and art, is moving. It's migrating from old-school traditional ledgers onto this brand new, super efficient and transparent digital foundation, all powered by blockchain. To get a sense of the scale we might be talking about, just take a look at the forecasts, and you'll notice right away they're kind of all over the map. You see projections from a few $100 billion all the way up to over $3 trillion. But this huge variation, it's not a mistake. It actually tells a really important story about what's being measured.
And here is the key to that whole puzzle. See, some of those forecasts are just counting the direct spending on the technology, the picks and shovels for this new gold rush. But others, the really big numbers, they're trying to capture the entire economic ripple effect. We're talking new markets, massive efficiency gains, the whole shebang. So the big takeaway is, no matter how you slice it, the growth being projected is just explosive.
So what's really the engine behind all this? What's driving this migration? Well, it really boils down to four key catalysts that are turning this whole idea from a theory into a reality.
First up, and this one is a biggie, we have the creation of institutional on-ramps. What this means is we're finally getting these regulated, easy-to-use pathways for the big money to enter the space. The approval of spot Bitcoin ETFs, that was like opening a huge, safe, and familiar bridge for all this institutional capital to finally cross over in a serious way.
And boy, was the impact immediate. We're talking about roughly $179.5 billion that just surged into global Bitcoin ETFs. Now look, that isn't just a number. It was a powerful signal that finally legitimized this asset class for traditional portfolio managers and forced the whole industry to build out that serious institutional-grade infrastructure.
And all that new infrastructure, it isn't just for trading Bitcoin. No way. It's actually paving the way for the second catalyst, which could honestly be the largest of them all, the revolutionary idea of putting real-world things onto the blockchain. This is the point where the thesis moves way beyond just cryptocurrencies and into the very fabric of our global economy.
So what does this actually mean? Well, you're basically just taking the ownership of an asset, let's say a piece of real estate or a government bond, and turning it into a digital token. And the whole point is to solve real-world problems. It's about getting rid of the high costs, the slow speeds, and the limited access of traditional markets, and instead letting these assets trade globally 24/7.
And let's be clear. This isn't some far-off future concept. It is happening right now. There are already billions of dollars in real assets on-chain. The leading category? U.S. Treasuries. You've got major players like BlackRock launching funds like BUIDL, specifically to bring these foundational financial assets into the digital world.
All right, the third driver is a little less flashy than finance, but it's all about efficiency. Major corporations are quietly, and I mean quietly, adopting blockchain technology. Not to speculate, but to streamline their own complex operations and save a whole lot of money.
And they're using it for incredibly practical things. Think about Walmart being able to track food from the farm all the way to the shelf to guarantee it's safe. Or imagine banks settling payments across borders in minutes instead of days. These kinds of real-world applications are what's building a strong underlying demand for the tech. And our final catalyst is the evolution of what's called decentralized finance, or DeFi. Now, it got a reputation early on as being kind of a speculative Wild West, but what we're seeing now is a maturation. It's growing up into a parallel financial system, one where you can lend, borrow, and trade, all without the traditional banks or brokers.
And the scale here is really significant. Even with all the market cycles, there's still over $93 billion locked in DeFi protocols on Ethereum alone. That capital is literally building the rails for a new financial system. And as more stable, real-world assets like those tokenized treasuries start entering the system, it becomes far more attractive to institutions.
Okay, so we get the forces driving this whole migration. But how would someone actually invest in this theme? Let's take a look at the different kinds of companies that actually make up this on-chain economy. You can really break the ecosystem down into 4 different layers.
It all starts with the core infrastructure, the picks and shovels of the industry, and it moves all the way up to companies that act as proxies by just holding these assets on their balance sheets. So at the miner layer, you have giants like Marathon and Riot. But what's fascinating here is that they are evolving. It's not just about mining Bitcoin anymore. They're becoming strategic energy and data center players that can also serve the massive demand coming from the AI industry. In the core infrastructure layer, you just can't ignore a name like Nvidia. The bull case is simple. Their GPUs are the essential hardware for both AI and crypto. The bear case is just as straightforward. That stock is priced for absolute perfection, leaving zero room for error or for a competitor to catch up. And for the gateways, you've got to look at Coinbase. It has become the trusted, regulated on-ramp for institutions. That's the bull case. The bear case? Well, its revenue is still heavily changed to the wild, unpredictable swings of crypto trading volumes, and that regulatory risk is always a factor. So with all these different players and all these layers, how does this translate into a coherent investment strategy? Let's walk through one potential framework for how you might think about building a portfolio here. One of the most common approaches is this classic core satellite model. The idea is to build a stable foundation with a diversified core and then use the other part of your portfolio to make smaller, more concentrated bets on individual companies you believe are going to be the leaders. So for that big 60% core, a thematic ETF is one popular option. And your choice really depends entirely on your risk appetite. An aggressive approach might use a fund like Block, which is heavy on the crypto-native firms, while a more conservative one, like Ledger, focuses on those established, big-name enterprises that are just adopting the tech.
But before we wrap up, it is absolutely critical to understand that this is not a risk-free investment. The potential rewards are high, yes, but the potential pitfalls are just as deep.
The primary risks are pretty clear. First, regulation is still a huge question mark. The technology itself carries security vulnerabilities. The market is defined by, well, extreme volatility. And finally, you have to remember that a lot of these companies are valued more on future hype than on current profits. This is definitely not for the faint of heart.
And that leaves us with the final question to ponder. The evidence really does suggest the destination, a world with more value on-chain, is becoming clearer. But the journey to get there? Well, that promises to be anything but a straight line.